Hello, and welcome back to Tech Fails. Tonight, we're digging up the tomb of a company so big, so dominant, that its collapse didn't just shake the tech industry, it redefined what a technology scandal truly was. We're talking about Nortel Networks. Back in the year 2000, Nortel was a titan. It was the centerpiece of Canada's economy, a global telecom powerhouse whose market capitalization soared past $250 billion. That was more than a third of the entire value of all companies listed on the Toronto Stock Exchange. They were neck and neck with rivals like Cisco, building the very infrastructure of the internet and the mobile world. They were innovators, pioneers, and for a fleeting moment, they were absolutely untouchable. Then, they simply vanished. Not in a slow, graceful decline over years, but in a catastrophic, almost unbelievable implosion. This fall was rapid and utterly devastating. How does a company, the company that essentially created digital telephony and was poised to rule the fiber optic age, go from $250 billion to bankruptcy in less than a decade? It seems impossible on the surface. How does a technological leader become the biggest, most expensive historical technical disaster in Canadian business history? The answer lies in a volatile mix of ambition, miscalculation, and ethical failure. Grab a coffee. This is the story of ambition, miscalculation, sheer bad luck, and a chilling financial technology scandal that brought down an empire. The fall of Nortel Networks. To truly understand the magnitude of the fall, you have to first appreciate the unbelievable height of the climb. Nortel's story actually begins way back in 1895 as the Northern Electric and Manufacturing Company. For almost a century, they were a reliable, successful equipment supplier, primarily serving Bell Canada. They built their reputation on being reliable pioneers in telecommunications. Critically, in the 1,970 seconds, they helped launch the SL1, one of the first commercially successful digital private branch exchanges, or PBXs. This PBX was essentially the brain for office phone systems and was a massive technological leap. This wasn't just a successful product. It was a revolution that moved the entire telephone network from the old analog system to the new digital one. Nortel was literally digitizing communication. Fast forward to the 1,990 seconds. The internet is emerging from the academic world and smashing into the commercial one, creating the atmosphere for the dot-com boom. Nortel, now renamed Nortel Networks, decides it's time for a major pivot. They chose to move beyond being just a steady, reliable supplier and attempt to become the absolute global market leader in this new, data-driven world. This is where the first and ultimately fatal strategic move happens. In 1997, Nortel, under the leadership of visionary and confident CEO John Roth, decided to bet the entire company on the emerging fiber optic revolution. This was a massive all-or-nothing wager on the future. The theory behind this bet was sound. The demand for bandwidth would be practically infinite, and the companies that controlled the high-speed equipment would control the future of the internet. They focused heavily on optical networks, IP networks, and wireless 3G technology. Roth's strategy to achieve this global dominance was incredibly aggressive. Buy. Nortel went on an acquisition spree that was breathtaking in its immense scale and staggering cost. They didn't just acquire minor companies. They bought what they believed was the future, and they bought it at inflated dot-com bubble prices. This was the first major step toward their historical technical disaster. The purchases began with Bay Networks in 1998 for $9.1 billion. This was a massive strategic move into the data networking space to compete directly with giants like Cisco. They followed that up with smaller purchases like Clarinet Systems in 1999 for $700 million. They were acquiring talent and intellectual property at a ferocious pace. The most dramatic acquisition came in 2000 with Qtera, a tiny fiber optic startup, acquired for an astonishing $3.25 billion. Crucially, this was a company that hadn't even generated significant revenue yet. The rationale was that they had proprietary technology to send data faster over long distances, which Nortel desperately needed to remain a global leader. Their strategy was pure, unadulterated hypergrowth at any cost. These massive purchases were paid for mostly with Nortel stock, which, at the time, seemed like a smart and virtually painless way to finance rapid growth. Their stock was flying high, fueled by the market's enthusiasm. John Roth often fueled this euphoria with confident, almost evangelical pronouncements about the coming bandwidth explosion. He famously told investors that Nortel was selling the picks and shovels for the internet gold rush. In 1999, Nortel's revenue hit $21 billion, and by 2000, their market cap peaked at an unbelievable $250 billion. Employees became paper millionaires, and the Canadian government viewed them as an engine of national prosperity. But beneath the stunning valuation, the company was silently building a ticking debt bomb and simultaneously making a strategic error of truly historic proportions. They were leveraged to the extreme. Every bubble, by definition, has to burst, and the dot-com bubble was certainly no exception. It began to deflate in late 2000 and officially popped in the middle of 2001. For Nortel, this wasn't just a momentary dip in the market. It was a direct, fatal hit to the core of their high-growth business model. Their primary customers, the telecom carriers, had critically overspent. These carriers had bought so much equipment during the initial frenzy that their infrastructure was now vastly over-provisioned. The demand for bandwidth didn't stop, but the massive multi-billion-dollar purchases did, drying up orders almost overnight. The shift was brutal and immediate. In the second quarter of 2001 alone, Nortel reported a staggering loss of $19.2 billion. This was, at the time, one of the largest corporate losses ever recorded. To cope, they quickly laid off 20,000 employees, followed by another 10,000 soon after. By the end of 2001, a shocking 50,000 jobs had been cut, representing roughly half of their entire global workforce. This sudden, catastrophic drop in demand immediately exposed the vulnerability of the technology they had spent billions to acquire. Many of the high-priced acquisitions proved to be in the wrong place at the wrong time. For example, the cutting-edge technology that Qtera was bought for ultra-long-haul dense wavelength division multiplexing was technically brilliant. However, the immediate need for it evaporated as carriers realized they already had sufficient capacity installed. These complex systems became sunset products before they even had a chance to achieve market dominance. They were casualties of a technological disaster rooted solely in market over-speculation. Nortel was now staggering under the immense weight of goodwill. This is the accounting term for the premium paid over the fair market value of an acquired company's tangible assets. When the market value of those acquired companies like Bay or Qtera plummeted, Nortel was forced to write down billions in goodwill. This accounting obligation directly led to those catastrophic reported losses. By the end of 2001, facing immense pressure, CEO John Roth stepped down. The company was already in a severe death spiral, but the worst financial and ethical conduct was still yet to come. The crisis quickly transitioned from a purely market-driven failure to a full-blown financial technology scandal. The new CEO, Frank Dunn, inherited an undeniable mess, but quickly promised the market a speedy turnaround. The internal pressure to return to profitability and hit targets was truly immense. This pressure, combined with a perverse internal culture, led to the dark heart of the Nortel saga, the accounting fraud. Beginning in late 2002 and escalating through 2003, Nortel executives began to artificially and knowingly inflate the company's financial results. The primary goal was clear. The goal was to reach an internal, predetermined profit target and thereby trigger significant, multi-million-dollar performance bonuses for themselves and other senior executives. Here is how this cynical financial technology scandal fundamentally worked. Nortel utilized what are known as provisions, or reserves. These are essentially buckets of money set aside on the balance sheet for expected future costs, like restructuring charges. In the good times, Nortel would deliberately over-accrue these reserves, setting aside much more money than was realistically necessary for those future costs. They called these funds cookie jar reserves. Then, in the lean, bad times, they would secretly and selectively release these excess, unnecessary reserves back into reported revenue. This had the effect of magically manufacturing profits. Think of it like a business declaring, actually, we only need $5 million for future litigation, not the $10 million we set aside. That extra $5 million instantly flows directly into the current quarter's income statement, making the company look profitable. Nortel executives used this exact method to deliberately turn what should have been reported losses into highly publicized profits. This was a sophisticated deception. For example, in the crucial first quarter of 2003, they manipulated reserves enough to swing the results from what should have been a small loss to a surprise reported profit of $187 million. This was the first profit reported in 3 agonizing years, and the market immediately cheered the news. The stock price jumped in response to the perceived good news, and then the senior executives, led by CEO Frank Dunn, cashed in big time. The driving force was a specific set of internal targets tied to massive payouts. The executives had bonus plans that would only pay out millions of dollars if the company achieved the designated sustained profitability. Once that return to profitability was declared using the manufactured numbers, the cash instantly flowed. Frank Dunn himself received a shocking bonus of $7.8 million, and other senior executives also pocketed millions of dollars. They had essentially manufactured the very financial conditions necessary to pay themselves. They awarded themselves millions, all while the company was still fundamentally weak, bleeding cash, and heading directly toward the abyss. This was a classic technology scandal driven by pure, undisguised greed. The manufactured profit, however, was merely a house of cards that could not stand. Whistleblowers and astute internal auditors eventually flagged the immense financial irregularities. By 2004, Nortel was forced into an embarrassing position, restating its financial results for 2000, 2001, 2002, and 2003. This massive correction confirmed the pervasive financial manipulation. The aftermath was immediate and severe. CEO Frank Dunn and several other senior executives were summarily fired. The stock market reacted with completely understandable fury and contempt. The company that had been valued at over $250 billion was now trading as a literal penny stock. They were swiftly delisted from major stock exchanges globally. Nortel then faced years of devastating regulatory investigations from the U.S. Securities and Exchange Commission, or SEC, and Canadian authorities. This was a long, painful, public dismantling. While Frank Dunn and others were acquitted in the subsequent Canadian criminal trial in 2013, the SEC did reach a settlement with Nortel. The company paid $35 million to settle the fraud charges, without technically admitting or denying the allegations. While the legal battles were painfully ongoing, Nortel tried desperately to limp along. They still had a core of brilliant engineers and innovative technology, especially in their promising wireless division. But the damage from the financial technology scandal was simply too great to overcome. Customers and suppliers could no longer trust the company's stability. When you buy critical, long-term network infrastructure, you need to know the manufacturer will exist in 5 years to provide essential maintenance and upgrades. Nortel's reputation was irreparably shattered. The years of internal chaos and legal defense meant that while rivals like Cisco and Ericsson were rapidly developing new 4G wireless and next-generation IP solutions, Nortel stagnated. This was a failure of innovation through distraction. Their once cutting-edge technology rapidly became sunset products. The failed projects weren't that the products broke, but rather that they never made it to the modern market or were simply too late to compete effectively. The company was effectively a technological giant trapped in quicksand, unable to move or breathe. The global financial crisis of 2008 to 2009 delivered the final, inescapable knockout blow. Unable to secure necessary financing and weighed down by massive pension obligations and crippling debt, Nortel Networks filed for Chapter 11 bankruptcy protection in the U.S. on the 14th of January 2009. This was not a reorganization attempt. It was a fire sale and an eventual liquidation. Over the next few years, Nortel's valuable assets were carved up and sold off piece by piece to its ravenous rivals in one of the largest liquidations in tech history. The wireless business went to Ericsson, the enterprise business was bought by Avaya, and the key optical and carrier Ethernet assets were acquired by Ciena. The pieces were scattered across the industry. Then there was the crown jewel, the massive patent portfolio. Nortel held over 6,000 patents, critical to fiber optics, 4G LTE, and the fundamental architecture of the modern internet. In 2011, these crucial patents were put up for auction. The ensuing bidding war was epic, featuring major players like Google, Apple, and Microsoft, all competing fiercely. A consortium that included Apple, Microsoft, and Ericsson, known as Rockstar Bidco, ultimately won the bid with a staggering offer of $4.5 billion. Google was outmaneuvered in a huge corporate loss. This patent sale became a critical, pivotal event in the history of mobile technology, as the patents secured by Rockstar became a strategic weapon in the global mobile patent wars that immediately followed. And just like that, it was over. Nortel Networks ceased to exist. The $250 billion behemoth was ultimately reduced to a portfolio of patents and a historical technology scandal case study. The Nortel collapse is not just a cautionary story of a failed company. It's a terrifying lesson in how corporate culture, market bubbles, and immense ethical decay can quickly transform a technological leader into a massive historical technical disaster. What are the key takeaways from this ultimate tech fail? First, the danger of aggressive accounting. Nortel's greatest failure was not technological. It was overwhelmingly financial and ethical. The accounting fraud proved that even a company building the very backbone of the internet can be undone by greedy, short-sighted focus. The focus on short-term quarterly targets, when tied to massive bonuses, created an incentive for manipulation that corrupted even the highest levels of management. It was a technology scandal where the technology was effectively the victim of its owners. Second, the cost of the bubble. Nortel's fatal flaw was mistaking a short-term speculative spending frenzy for sustained, infinite market demand. They massively overspent, over-leveraged, and positioned themselves for a future that arrived years too late. When the dot-com bubble burst, it didn't just hurt them or set them back. It was a mortal wound that ultimately killed the company. They never truly recovered. The ghost of Nortel Networks is a powerful and necessary reminder. It proves that in the volatile tech world, the pressure for explosive growth is constant and immense. But when that pressure overrides due diligence, technological foresight, and basic business ethics, even the largest and most established giants are susceptible to the hardest of falls. This was the story of Nortel Networks, the $250 billion giant that disappeared almost without a trace. What failed project should we dig up next for our next episode? Let us know in the comments below. Don't forget to like and subscribe for more deep dives into the greatest tech fails in history. Thanks for watching, and we'll see you next time.